Russia's invasion of Ukraine is nothing short of a disaster, both in terms of the economic impact and the humanitarian toll. So it might come as some surprise that we just saw US stock markets react by having its best day in months, with the S&P 500 up around 1.5% and the Nasdaq up over 3%. This just after weeks of losses. And the question you might be asking yourself is why? When the world seems on the brink of war, inflation levels are still at record highs, and economies are still recovering from COVID-19, why would stock markets rise? But before we go into this, I just want to recognize the very real impact that this is having on people and families. And while we can all get caught up in how the market reacts and how it impacts our finances, that should never detract from the human element. I really hope that if you're watching this from Ukraine or even from Russia or nearby regions, that you and your families are staying safe during this really difficult time. Okay, so why would stocks go up during a crisis? So under normal circumstances, people tend to sell out of riskier assets like stocks. And that's because they see other assets like cash or gold or bonds as a safer place to put their money when there's a crisis. But as we've seen in the last couple of years, for example, the 2020 market rally, markets don't always react in the ways that we think they will. And that's because there's just a lot of moving parts. It's nearly impossible to predict where the market is going to go. And the truth is, at this stage, nobody knows for certain why stocks moved up. All we have is a lot of speculation. Right now we have high inflation, record low interest rates, record high debt levels, and now a potential war along with trade barriers. All of these things are impacting stocks to varying degrees. So I did a lot of homework myself into this, and I've got a few views of my own, but I thought instead of theorizing on what my views are about the situation, it'd be better to interview IG's market analyst Kyle Rodder. And that's because he not only has his finger on the pulse at all times of global markets, but he also picks up on things a lot faster than a lot of news services can. But before I go into the interview, if you like this video, please hit the like and subscribe button. It really does help me to keep making these videos.
Considering effectively now we do have a full-blown invasion in Ukraine. But in saying that, I think that at the moment the situation does remain very, very fraught. We are looking at obviously a humanitarian and economic disaster in Ukraine, which could permeate across the world and have several second-order impacts.
One really good point that Kyle emphasized is that even when something really bad is happening, stocks can still react positively because the outcome might not be as bad as what people had been fearing.
There was some news out last night that was positive. I think there's a little bit of a reticence from the West to talk about, putting troops on the ground, a reluctance to be too aggressive at the moment in hopes that these tensions will de-escalate. Some of the sanctions that have been announced so far are sort of being interpreted as perhaps not as severe as might have been expected, considering effectively now we do have a full-blown invasion.
And while the US and NATO alliance sanctions that were placed on Russia were expected if Russia was to invade Ukraine, they're not as severe as what some people had been predicting. And we can see from Washington's release that the sanctions imposed include on major Russian banks from transacting with the US. They've also halted the imports of all US tech products into Russia. That includes semiconductors and telecommunications equipment and computers. And some of this is needed for their own manufacturing. And while this is bad news for Russia, it's not as catastrophic as it might have been. For instance, if sanctions were placed on Russia's energy market, that would have been a lot worse. And because these sanctions aren't as severe as what some people had been predicting, the likelihood of Russia retaliating and for there being a tit-for-tat war between the US and Russia and other NATO allies has been reduced. Perhaps one of the biggest questions now is the question around whether interest rates will still continue to rise as the Federal Reserve has said they will. The background being that when inflation rates get too high, which is what we're seeing now, they're at risky high levels, central banks will raise interest rates to cool inflation. When they raise interest rates, they cool borrowing rates, that cools spending, and prices drop. But when you raise interest rates, it also slows an economy down. And when a war breaks out, that also slows an economy down. So central banks are maybe less likely to raise interest rates as high as they were planning, because otherwise it might be a double whammy. As you probably already know, when interest rates are low, that makes the stock market more attractive relative to the returns that you can get by keeping your money In the bank, by that same token, when interest rates are predicted to rise, stock markets tend to fall. So what we're seeing happen is potentially the opposite of that, with some predicting that the central bank will not raise interest rates as many times or as high as they had initially planned. One final point that Rodder emphasized, which I think is a really good one to raise because it's not something that necessarily always talked about, especially by news services, is that when there is very high volatility, there are always profit takers. And this means that prices aren't always rational.
But again, these are just a function of very volatile markets, and any day's trade shouldn't be interpreted necessarily as an indication of things that are getting better, and by the same token that they're getting much worse. It's just a very uncertain certain environment, and that comes with big price movements in both directions.
Yeah, right. So part of it could just be a matter of profit taking rather than reacting logically. They're just seeing it as an opportunity.
Yeah, I mean, in the very short term, you've got to remember that speculators and technicals drive markets, and these things are very intricate. And again, when you do see a big drop and you start to see markets trading on headlines like we are now, and the last couple of weeks, it's been really illustrative. Every day things will move around. It's really choppy, really volatile. But you want to keep an eye on those sort of underlying trends, and you want to know the story as to whether things are getting better or not yet. And for the time being, it's still an uncertain environment. That means that for me, risk appetite is probably going to remain weak. Equity prices are probably going to remain, risk is probably going to remain skewed to the downside.
So in other words, the price rally that we saw may not have had any real logic to it at all. May not have been because anything positive came out of this. And as for the big question that I'm sure everybody is wondering, whether or not stocks will continue rallying over the next 12 to 24 months, well, in case you missed it, Kyle Rodder does not think that will be the case. In fact, he thinks we'll finish 2022 with stocks lower than we see today. And look, while it's nearly impossible to predict where the stock market will be in the future, I think it's pretty safe to say that stocks will remain pretty volatile for at least the next 12 months. As always, the key to long-term investing is to not make rash decisions. And that's because when you look at historical charts, the stock market does tend to rise slowly over time despite the many crises that we see over the years. Okay, that's it for today. If you like this video, please hit the like and subscribe button, and I'd really like to hear from you as well. How do you think the next 12 to 24 months will pan out, and are you doing anything to prepare for it, or are you just planning to wait it out?